In the last 10 to 15 years, most would agree that we've had it genuinely easy with financial markets. Over the past 10 years, the revenue of the S&P 500 has generally doubled and the price has tripled. The highest federal funds rate we've seen before what's going on right now was only at 2.5%. So it's been a great time for organizations and investors. Cash has been cheap to get to, which has made it simple for organizations to expand, valuations to increase, and investors to make cash. Towards the end of 2019, it seemed like anything you purchased was multiplying quickly. However, the bubble burst. The pandemic tossed the world into mayhem, organizations closed down, and the financial markets collapsed. The recession was long and dark, and the investing world was pushed to the brink of collapse. The central banks of the world stepped in, printed trillions of dollars, gave it to organizations and consumers, and postponed the issue. However, we are now up to speed, and with inflation at fundamentally 40-year highs, the round of printing cash to save us cannot work anymore. The Federal Reserve is now raising interest rates to sharply limit citizens' and organizations' capacity to access cash and is therefore slowing down the economy. What's more, to put things lightly, it has cost the financial sector somewhat of a migraine. Cryptocurrencies have been destroyed, real estate is falling, huge name organizations are currently struggling, and the stock market is looking really flimsy. Investors are selling up with fears that the deep recession we needed to have is now here. Yet, despite all that has happened up to this point, and all that will occur over the following year or two, this could really be the best time of your whole life to get ahead and build your wealth. So let's discuss why right now is a major opportunity and how you can utilize it for your benefit. Welcome to Bulls and Bears. If you are new to the channel, hit the like button and subscribe if you enjoy our content. Now, let's go back to the video. There's a ton of psychology involved in investing, much more than people understand. The basic idea of investing is to purchase low and sell high. However, a lot of people do the specific opposite. They purchase high and afterward sell low. They don't intend to do this, but when the circumstances get difficult, the uncertainty, the doubt, and the fear simply scare them out of the market. However, as individuals like Warren Buffett, Charlie Munger, Mohnish Pabrai, Guy Spier, Phil Town, and each one of these others would agree, when the market is down greatly, that is the best opportunity to invest. The lower the entry point, the better. It's a truly intriguing phenomenon. The central thing that causes this backward psychology is that the vast majority don't have clear investment objectives, and they haven't committed to a long-term investment time horizon. Thus, when the news gets awful and the recession hits, rather than quickly jumping all over this opportunity, they run away from the chance of short-term pain. However, as a general rule, that is a horrible strategy. Since 1926, there were 15 recessions and 11 bear markets, 12 assuming you include the 2020 drop. The bear markets went on for 14.7 years total, and to go with that you have 75.4 years where the market was in a bull run. Ponder on that a little bit. These frightening, world is ending events happen very infrequently, and if you have the stomach to contradict some common norms and invest during these periods, you're frequently very much compensated. Simply look at these profits coming from the Great Depression. You made 265% across 4.4 years. After the next bear market, you made 43% in 1.8 years, 210% in 4.1 years, and 908% across 14.8 years. And the pattern goes on. Assuming you were the person that put your cash where your mouth was, at the absolute bottom of every one of the greatest bear markets in recent history, this is the very thing you would have returned only a year later, 20, 30, 40, 50%. While it's difficult to perfectly pick the market bottom, and honestly, you probably will not get precisely those returns, it shows you exactly how large of an opportunity a bear market can be. For instance, if you invested at the peak of the market before the 2020 covert drop, you would have made around 9% of your cash. However, if you chose to invest at the market low, which was only a few weeks later, then you would be up around 60%. That is how much of a difference your entry point can make. And remember that these enormous drops are extremely inconsistent, with 14.7 years of bear markets and 75.4 years of bull runs. These moments to stomach some pain for long-term gain are really uncommon. Recessions are huge opportunities. But how might I really take advantage of this chance as an investor without committing some gigantic error? Well, step 1 is to keep to speed with what's going on in the market, so you know whenever these opportunities are out there. And step 2 is to execute your strategy perfectly, whether it be passive or active investing. Step 1 is certainly to keep yourself updated, but critically, step 2 is to then execute your investment strategy properly when you see a disturbance in the markets. As we probably are aware, there are two primary approaches to long-term investment. There's either dollar cost averaging, or there's Warren Buffett-style long-term value investing. And for a great many people, they will pick the previous. They're going to pick dollar cost averaging, and for those that don't have any idea what dollar cost averaging is, it's just taking your cash and diversifying it across the entire stock market through something like an index fund. SPY, for instance, is the exemplary S&P 500 index fund, and it's the biggest index fund in the entire world. So they pick a market tracking investment, and from that point, investors will invest the same amount into that market tracking investment at regular time intervals. So like $2,000 every 6 months or something to that effect. And your cash through that index fund is split across the entire market. So this system truly is intended to remove all of the emotions from investing. However, it still provides you with the reward of the market's long-term performance, which is around 10% yearly for the S&P 500. But you don't need to do any of the worrying about your investments, reading yearly reports, or anything like that. Obviously, at face value, this strategy doesn't seem as if you're timing the market and explicitly making the most of the amazing opportunity that is a stock market crash. But actually, you are, because when the stock market is exceptionally high, that $2,000 won't get you as many shares. On the 9th of October 2007, $2,000 brought you 12.75 SPY shares. However, after 1 year, as the market was diving, your $2,000 got you 20.5 shares. It's genius when you think about it. Normally, you will purchase a stack more shares when the cost is lower, and much less when it's higher. However, you haven't needed to transform anything about your investment behavior. Thus, I truly like dollar cost averaging, and that is the genuine way that passive investors jump all over the chance that is a major market slump just by doing what they've generally been doing all this time. However, beyond passive investing, numerous investors really do get a kick out of the chance to have more noteworthy command over their portfolios and opt more for a Warren Buffett-style approach of purchasing individual organizations. They comprehend that they have solid competitive advantages, they have gifted management teams, and they're at the margin of safety prices. Now, I won't go over that entire strategy in this video, as that would require a lot of time. However, one thing I want to address in this video is how those active investors can guarantee that they will not get screwed while investing in this violent economic time. And the first thing we need to think about is what's really happening right now that is making organizations suffer. Furthermore, right now, the principal issues are high inflation and rising interest rates, which implies that costs are higher, debt is more expensive to service, and consumers are spending less. So how can you be sure that a business will be able to thrive in a climate like that? Right off the bat, the business you're taking a look at needs to have pricing power. Pricing power implies they've accomplished a competitive position where they can raise prices and experience no drop in sales. For instance, right now, numerous organizations are reducing back their prices since shoppers are spending less on discretionary items. However, organizations like Coca-Cola enjoy strong competitive advantages in that they're able to raise prices without experiencing an enormous drop in sales. As a matter of fact, in Q2, They increased their beverage sales by 8% and their concentrate sales by 4%, regardless of cranking up prices. And this trademark is crucial to success during an inflationary period. As Coca-Cola's expenses rise, they can undoubtedly give those expenses to customers and experience no ill impact. Thus, that is a main trademark that battles inflation. However, the other huge variable to consider right now is the increasing interest. And the principal result of increasing interest rates is that rolling over debt becomes more costly. So an ideal way to guarantee that your business holds up well during this time is to guarantee that they have minimal debts. For instance, Google has more money than they have debt. Their debt-to-equity ratio is only 0.05. They acquire more interest than they pay. Meta is far superior. They have no debt at all. As Peter Lynch would state, it's very hard to go out of business if you don't owe anything to anyone. Thus, low or no debt is very important. And then, a more general consideration is just thinking about the business model. Ask yourself, does this business model hold up well in violent economic times? For example, supermarkets regularly outperform in recessions, since people can't stop buying the essentials. This also applies to insurance companies, because individuals won't quit paying for house or vehicle insurance even if they're somewhat tighter for cash. Yet, on the other side, as rates rise and customers have less to spend, you realize that travel organizations may suffer. Vacation plans may be tossed through the window as the average cost of living eats up more discretionary income. So there are different variables to consider. However, for active investors, it's worth thinking about business models, pricing power, and debt levels. And then, for passive investors, simply fight the good fight. Remain strong and go long. But generally, guys, that is the reason recessions present such huge opportunities. And hopefully, this video arms you with the information to take full advantage. So what do you think? Do you think that the upcoming recession would be the perfect time for you to invest? Why or why not? Let me know in the comments below. If you enjoyed this video, hit that subscribe button, click on the notification bell to be updated on our new videos. See you in our next video.